The next metric, return on net assets. Now, let's put this metric in place compared to the other metrics we covered. We started off with the return on sales, which purely focused on the income statement. Now we moved into return on investment as the next step, which incorporated the assets. Now, return on net assets is a little refinement of the return on investment. And here you will see the power of the controller, which defines the formula a little bit differently. And suddenly this world works a little bit differently. So what is the idea of RONA in particular compared to ROI, return on investment? So return on net assets, or RONA, answers the question, which return does the company generate on its net asset? So you can see the only difference compared to the ROI is we have now inserted a little term called net. So what is net? Well, let's see the definition and then we can discuss what the difference is. You can see in the definition, the red part, the denominator is again EBIT, earnings before interest and taxes. Why is that? Because we would like to measure the operating business. But in the denominator, we so far had assets. Now we have net assets, which is defined as total assets minus non-interest bearing liability. What the heck is this non-interest bearing liability? Well, think about it. It's talking about the right side of the balance sheet. So on the right side, is there some kind of liability, some kind of position on the right side, or we don't have to pay interest for? Let's go to the right side. We have on the right side bank debt. So what would that be? That would be long-term loans or short-term loans. Do we have to pay interest on that? Yeah, in those days less and less, but we do have to pay interest normally. So that's not a non-interest bearing liability. What about equity? Equity, if you look at owner's equity, is this actually a position where you don't have to pay interest on? Well, no. It's correct that the owners cannot send you a little invoice saying, I would like to charge you 5% interest on the equity. They cannot do that. However, they still expect a return on the equity. And how does that work? Well, you either pay them dividends or the share price of the company goes up. And that makes the owners happy. So clearly, an owner would like to get some kind of return because an owner is not a charity organization. This owner would like to make money. So there is one position on the right side, however, where you can get free financing. And that position is called accounts payable. So what is accounts payable? It is an invoice you obtained from your supplier and you actually didn't pay the invoice yet. Now, can you finance your business based on this? You bet. If you look, for example, at big retailers, how do big retailers finance their business? There are some huge retailers which hardly have bank debt and hardly have equity, but they finance themselves on the shoulders of the suppliers. So what are the ingredients of financial success? For me as a finance person, they're always the same. Buy low, sell high, collect early, pay late. Now think about it. If these four imperatives, which haven't changed in the last 2,000 years, even the guy selling oil lamps on the main market in Jerusalem did know that these were the four imperatives of finance. How much did we cover them so far? Buy low, sell high, was that covered by return on sales? Yes, it was. But buy low, sell high is the only thing which really the return on sales covered. We then went to ROI. Does that one cover collect early? Yes, it does, because it included all the assets. If you collected the invoices quickly, you didn't have a lot of receivables, that brought down your assets, that brought down your denominator, and that increased your ROI. What the ROI forgot was that pay late is part of doing a business. And now we are introducing the pay late component to the formula. by taking in the denominator here of our formula, not only to add total assets, but deduct non-interest bearing liabilities. That's a very complicated word for accounts payable. So what does that mean? The later you pay your supplier, the higher your accounts payable, the more you can actually deduct here in the denominator. And the more you can deduct in the denominator, the higher your RONA. And here you see what a little mail from the controller can do to a company. If you measure somebody based on ROI, then somebody couldn't care less when we pay suppliers. However, the moment we now change from ROI to RONA, send a little email to all our operating managers and say, by the way, your bonus in the future will be based on RONA. And that's how it's defined. A good manager needs a few seconds to find out that he or she now has a new lever with how you can make sure that you get a high bonus. And that means you pay the suppliers as late as possible. So what's the definition of it? Well, very similar to RI. You can see the denominator again is 10. EBIT has stayed the same. Assets are again 100. Same thing as in the ROI, but we deduct now the 20, which comes from the right side of the balance sheet, accounts payable 20. So the more you can deduct here, the better you actually look in terms of this formula here. So if you calculate this number at year end, it's quite clear what happens in many companies at year end. If this balance sheet is prepared on the 31st of December, then people prepare for this metric to be calculated based on year-end figures. So they stop paying supplier bills at year-end. This leads to an awful lot of liquidity problems in some medium-sized companies because all the large companies have switched from ROI to this metric called RONA. And as a result, the suppliers, the small and medium-sized enterprises, get their money later and later in this world. The RONA is sometimes also called ROCE, stands for Return on Capital Employed, or Return on Invested Capital, ROIC or ROIC in there. Yeah? Also, sometimes companies actually don't use EBIT, but use a figure called earnings before interest after taxes. So what you actually do is you leave out the interest, but include the taxes to calculate this number, which goes in the direction that I say, dear operating manager, you have no possibility to optimize your financing structure. So that means interest is non-operating. But taxes, I would like you to look into taxes as well, to optimize taxes. So you can see in which direction we are heading here. We have moved from return on sales, which only focused on the operating elements from the income statement, to ROI, and now we actually have moved to the right side of the balance sheet to include some elements from the right side of the balance sheet as well. This clearly is currently the most widely used metric to manage businesses which have significant assets. It is a metric which obviously is not that straightforward. You need to explain it to your managers in there. However, if you talk to a retailer will tell you, you need such a complicated number to tell your employees, your managers, that payment conditions to suppliers are actually very important. That is common sense. I need to negotiate with the supplier what I pay and when I pay. And it is obviously to my advantage if I will actually be able to pay as late as possible, because then I don't have to go to the bank and I don't have to ask my shareholders to put in more money. I have the business financing itself by all the payments which are delayed to the suppliers. So I fully see this is a relatively complex metric, but it would be important that you try to understand the dynamics this kind of metric actually generates in some industries where we have medium-sized companies going bankrupt because large companies are paying later and later. All right, I hope this relatively complex metric is understandable to you as well.